All right, what's up, everybody? Welcome to the Friday Mastermind. Every Friday, we are here as mortgage leaders, uh, people who want to be modern mortgage advisors, data-driven, advice-driven leaders to get better. Sometimes I'm bringing in top-performing loan officers, and today we actually have a top-performing mortgage leader, someone who does a lot of production personally and who leads I think more than a branch. We have Dan Rawitch. We're going to get to Dan pretty quick, and he's going to give us a market update for the first half and give us his predictions on not only what he thinks rates are going to do between now and the end of the year, but also what he thinks interest rates will do next year. Mr. Bookspan, I love that shirt you have on, Mr. First Home IQ founder friend, actually actual founder, co-founder. What's up, brother?
It is always amazing to be here on a Friday with all of you, but I'm super excited to catch up with Ryan and Dan and hear what they have to say. It was great seeing you in Dallas. I wasn't expecting that you and I were going to get to hang out there since we were there for different events, but anytime that I get to put my arms around you, give you a big hug is always a great day. And we're missing Dee Bird today. She's tied up, but it was also fun to spend time with her leading a room full of really cool loan officers, real estate agents, and a title rep through exactly what to say. So we had a blast, and I'm just fired up to be here because we always want to learn from Dan what's going to happen with interest rates. So now they finally have come down a little bit. So this is going to be exciting because I haven't been paying attention to what's going to happen next.
All right. So Dan, before I bring you on stage, Ryan, you know what we're going to talk about. You also know about what you're going to say. If you were bringing Dan into a sales meeting with your team, and he's getting ready to give his update, just give us a minute on like what advice do you tell to loan officers that are watching this and other producing managers, and then we'll bring Dan on and he'll share it. But any just advice on how to listen to the next 30 minutes?
Yeah, well, I have a great deal of respect for Dan. We go way back. Know him pretty well, and he's the best. So I definitely would listen very closely to what he has to say as far as where the market is likely to go from here, and then use that information to arm your clients as well as your agent and financial planner referral partners.
Yeah, and then I'll add one more thing. When you're listening to this, the goal is to be a better advisor to borrowers and helping them make better decisions. And then your goal is also to be a better advisor to realtors. And there's going to be a lot of things that he says that are just like, okay, noted, noted, noted. And then there's going to be some things that like, oh, I need to make sure I want that slide. I need to add that slide to my deck. Oh, I want to make a video out of that. So I would just recommend that when you hear those things that either one, you want to add it to your presentation, or two, you want to make a video, timestamp it, like write down, like it's 9:04, timestamp it and put a headline on it so that when you go back and listen, there's things that you're going to want to learn so well that you can teach them to realtors and consumers. So Dan Rawitch, the chief economist for the MortgageCoach Trust Engine community for maybe going on 2 decades, over 15 years.
16 years, yeah.
Thank you for your service. Thank you for your daily updates in our Rate Watch app. If anybody who has not downloaded our Rate Watch app, get it downloaded. Dan updates it almost daily with what he thinks is happening on a day-to-day basis. But tell us what we should know in today's market.
All right. Thanks for having me, Dave. Really appreciate it. Todd, always great to see you. Ryan, good. It's been a while. You haven't changed a bit, though. So yeah, I've got some slides that we'll jump in and look at. Before I get too far, let's see here. Is that the right desk, Dave?
Yeah, we see it.
We see it. Yeah, you only got to tell Dan Rawitch one time.
Unless it's coming from my wife, then usually 4 or more are normal. So I want to start off by saying I thought I was going to have to come here and fall on my sword. Instead, I'm just going to kind of, puncture myself a little bit because I told you guys the last update by the end of the first quarter, maybe going into the second quarter, we would see rates in the 5s. So I was late. But there's a while there where I was like, oh my God, I don't want to go live with Dave and talk about how wrong I was. But you know, it's hard to really understand when these various economic factors are gonna come into play. So I'm okay with being late with the prediction, as long as it's not too late. There's an old saying on Wall Street, even a broken watch is right twice a day. So I do have that going for me. Another thing before I jump into the slides,
By the way, guys, I do want to just comment. Love your humility. Love the fact that your transparency, and love it, bro. That's why you
thanks.
are Dan Rawitch.
Jesus. So I also just, if you guys know Barry Habib, I just, you know, I think any prayers that we can throw his way would be, you know, really worthwhile. He's been fighting cancer and just finished his last round of chemo. So I didn't know he was struggling with that. I really didn't. But prayers
Yeah,
for him.
I want to echo that also. I've gone back and forth with Dan, his son, and yeah, his attitude is amazing. His service to our industry is, you know, unbelievable. And then he continues to pour in, even though he's fighting a pretty tough fight. So big prayers and hugs for Barry.
Yeah, I God forbid I have to ever deal with that, but I would hope to be as courageous as he is.
Agreed.
But don't tell him I said any of that. Okay, so the whole purpose here is to talk about what's going on in the economy, because as you guys know, that's the driver of interest rates. Certain economic events are going to have greater impact than other economic events. There's no bigger event than a Fed easing or raising rates. But way beyond that being big is to ease for the first time in, is it 6 years? 2020, no, 4 years. But it's been a long tightening cycle. And what everybody wants to know is, how low will they go? Well, first of all, as you know, they've gotten a little bit worse since the Fed meeting. And I've talked about that in my daily reports, because the market hates surprises and will usually put itself in a position that it will not allow surprises. And so the market's going to start pricing in whatever it thinks is going to happen. And we now know, I'm a little surprised by this, but we now know that 50 basis points was fully priced into the market. And we know that because things got worse, not better. Because what happens is people build in this expectation, and then when it finally happens, the market says, so what? And that's that old saying that again on Wall Street is buy the rumor, sell the news. So I think this has been a really good example of that. Now, this is a very interesting slide, because what this is telling you is each time there's been a Fed easing cycle, and that's what these circles are, then the effective rate of interest will match the 30-year mortgage rate. So way up here, we got the 30-year mortgage rate, and way down here, we have the effective rate. This is of all mortgage debt outstanding. And I thought that this was a really fascinating slide, because we've had some huge divergences from 30-year to the effective rate. But every single time, rate has come down to match the effective rate. And that tells you you could be in the force. And Dave, last time we talked, I think you said, okay, when? And I said, well, let's say by the end of first quarter. Okay, what? And so it's when I said we'll be at 5, and I really think we'll get to 4, and I still believe that. So a little spoiler alert there. Existing homes, I'm going to tell you guys stuff you already know about the housing market, but it sort of all does weave in here. And what we know is existing home sales are falling pretty hard. We knew at some point they would, and now they are. Home inventory is just wow. You can see what's happened here. And then months on the market, you can see what's happening as well. And inventory is growing. So what drives prices, right? It's that old adage, and that is not enough supply and too many buyers. That's the definition of inflation. So what we've had is almost no supply. And so you can't even argue that there's been too many buyers because the supply has been so bad. But there have been a lot of buyers. And I don't think that changes. I think demographically, the amount of buyers hitting the market's only going to get stronger. The question is, will this fast growth in inventory we're seeing outstrip the macro demands of the millennials, whoever, baby boomers? Believe it or not, I'm buying another house that I'm going to actually live in. And I didn't, I'm going to be 66 in December. I know I look way too good for that, but it's true. My wife is laughing really hard in the other room. Ryan and I talked about it. I'm still sexy. Look at Dave. He's like, did you just say that? So, you would think again that I wouldn't be that active in the housing market because going back historically, by the time men reach their 50s, theoretically, they're done with their really big spending. We start calming down. But I think that the baby boomers are maybe going to defy that to a certain degree. Because honestly, not saying this because it's me or to be funny, but I feel like 60 really is 50. Because I remember my dad was my age, he was old. And maybe that was my perception, but like I no longer think of 70 as old. And 10 years ago, I would not have said that. So I think that these macro events between boomers not being satisfied yet, or maybe when a downside, and then of course this whole new generations that are coming up. What astounded me, and I did say right to the end that I would be surprised the Fed cut half. Number one, Powell's not been a Fed to surprise anybody ever. And I suppose by the time he gave the decision, the market was pretty much leaning that that's the way it would go. But it was not necessary. And I'm not one that usually would say that, but this slide is talking about financial conditions, and financial conditions have not been this loose. Sorry, we haven't seen a cut while financial conditions have been loose since 1992. And some of us remember that one of the biggest refi booms ever, well, for its time, was 92, 93. It was unbelievable. But then the Fed ended up raising rates 17 times in the next like year or two, beginning in like 94. So I'm hoping that we don't see a situation like that where he may have done this to be political, and that would shock me, but it's very strange when you look at this and some other slides that he did reduce by a quarter because the conditions don't call for it. Not that everything is rosy. The Architectural Billing Index is something that I watch. It's one of those sort of quieter, unknown indicators, but it's really accurate. And the index was down to 45.7 in August, which is down from 48.2. The big point here is anything below 60 increases a decrease in demand for architect services. Well, everything starts there, right? You can't build a house or build a building or build a shopping center without first hiring your architect. So it's a good leading indicator. And then as far as indicators go, the US leading indicator declined 0.2% in August. And you don't want that declining, you want that rising. And it was recorded its lowest level since May of 23. So something like this, yeah, the Fed's going to look at it and feel better. There's this mix of news that completely supports what he did, and then some things that, like I showed you, half was a lot. This really shocked me. This is manufacturing spending, and so you can see in 2022 what the spending was. You can see pre-pandemic what the spending was. And then all of a sudden, 22, 23, 24, it jumped literally through the ceiling. And this has not been inflationary. You would think that it was. And there's a lot of reasons why it's not. And the fact is that to see this much growth in manufacturing spending and not see a growth in inflation, because you have to realize the whole period while this was getting stronger, inflation was going down. So that's a good thing. And I'm sure the Fed, I've always believed and said that a really strong economy has zero to do with inflation. It has zero to do with interest rates. The Fed has always thought that it does and acted inappropriately because of that paradigm. But my gosh, we've seen, the 50s and the 60s, just decades of just really good, solid growth, appreciation, great lives, everybody's happy, and not seen any inflation. This inflation, I probably said it too many times, back to inflation, the definition is too many people seeking too few goods. So pandemic comes along, and not only do we have too many people because we stuffed money in their pockets, burning a hole in their pocket, they went to buy and there was nothing to buy. There was literally, so we had literally way too many people, millions, chasing nothing. The ships were all caught out in the harbors and nobody was making anything. That's what caused inflation, nothing else, not the money supply, um, that. And that's why it's going away. We all teased the Fed when he said it was transient, but I said when we were laughing at him, well, inflation's always transient. It's never been here forever. So the question is, and why I think the Fed was ridiculed is he talked about transitionary as if it was going to be gone in a quarter, and it just took longer. So money growth, M1, this is the money supply. These are bank accounts, etc. And again, there's an old fallacy that says when money supply grows, so goes inflation. Again, not the case. But I will tell you, you can see that M1 is beginning to really tick up here after falling very hard. But this does not worry me in terms of inflation. Mortgage demand, let's see here, 8-inch tire, below the pre-COVID norm for the week of September 13th, but well above the level that had been stuck at since April. So this is sort of interesting. It is slowly turning up, and that's a good thing, and that's only going to get stronger, in my opinion. I think you guys are going to have a really good year, for all the reasons so far that I've said. Labor market, this was like the Fed's biggest concern here. There has been a notable weakening in labor, and there's been a notable weakening in wages. And this is showing you, I hate when you can't tell the lines. Anyway, you can see wages are going in the wrong direction. And this is, to me, just another example of the Fed being completely high on something. The Atlanta Fed, which is called Fed Now, or GDP, they have GDP Now, and they're saying for the third quarter, which we're in, are we in? Yeah, of course. 3% GDP, but yet the range of top 10 and bottom 10 forecasts from respected analysts, blue chip consensus, if you will, has us below 1%. So the private sector has us, teetering on recession here, and the Fed Now's model has us way up here. But you can see that model's all over the place. I think they're going to have to do something with it, because you shouldn't see this kind of swings in forecasts. This is really hard to see, and I'm not going to read it to you, but I think that if you take the slide, you should have no problem blowing this up, or I can try to figure out how to get it to you bigger. And it was posted but a lot changed about his saying this time versus last time. And I think a lot of it had to do with A, making progress in inflation, B, a weakening labor market. So this is worth a read, and it's really interesting. I don't know. To me, depending on, of course, the client, this is the type of stuff I loved to share when I was the loan officer. Actually, everything I'm showing you, I love to share as a loan officer. It just puts you so far above the competition. I mean, how many loan officers are going to sit down and talk about this sort of thing? And I think just by having the slides and having a little story or takeaway for each slide, um, you should use these. That's my personal opinion. So in closing, this is the famous Fed dot plot. Every dot is a different Fed member. And this is a very dynamic graph, but you can see right now the median dot in 24 implies 25 basis point cut in November and December. Keep in mind, these dots are the Feds. So it's not a bad little cheat sheet to see where we think things are going to go. And the Fed continually will share the differences, from one point to the other on the dot plots. So you can see here after 25 and 25, and so in December, we'll have seen a 100 basis point rate cut, and then a total of another 100. That totals the 100, which I just said, and then another 100 across 8 meetings in 2025. That's a total of 200 basis point Fed funds cut, and that gets you in the threes, and that gets mortgage rates in the fours. That's just kind of historic spreads. I think that's all I've got. Oh, where'd that come from? New residential construction. I have always said that builders are psychic. They seem to know exactly when to pull things in. And so it's very interesting that building starts, housing starts had been dropping this much. Builders clearly saw what was coming. More inventory, higher rates through this period from 22. It did tick up just a little bit here, but you don't want them. You don't want them. We don't want to see housing starts get any higher than they are, because we need to absorb this new inventory that's going to hit the market. So the builders would be foolish to flood the market with new homes when I think we're going to have a small existing home glut. Okay, that's all I've got.
All right. So if you could stop sharing your screen, Dan. First of all, thank you very, very much. All these slides, guys, will be available in our Facebook group. So there's a file section in the Trust Engine Productivity Mastermind, and you can download these slides and do what you want with them. Dan's always so generous to give these. So I want to make sure we net it out. So you think, and I think you said between now and end of Q1 of next year, rates could be in the fours. That's very possible.
That's about the right time frame. Yeah.
Okay, and
Good dribble
by
into
the
the
end of
second quarter.
That's people.
and by the end of the year, down another half
Well,
in rates.
I still think we need to go down and test 3.5%. We got down to 3.6 and bounced pretty hard from there. But I do think I'm talking about the 10-year treasury. So I do think it probably runs back down and tests 3.5.
Okay.
And that's going to bring mortgage rates down another 3/8. Sorry, 1/8 to 1/4.
So Todd, what I want to do now is I want to give Ryan a chance to unpack that and get ready to do his producing leader message, and then have you close out this first half. So you kind of be ready to do a win by noon. This is what this means. Take action, and after Ryan goes. So Ryan, you just heard that update. What actions are you going to take? And then, I mean, and we can unpack this in more detail, but give us a high level, and also any questions you want to ask Dan before he has to jump.
Yeah, and certainly we're gonna, I think, unpack and go into more detail about what we are doing now, taking action on both purchases and refinances, in the market with the opportunity that the lower rates has given us already. Right. Quick question for Dan. One of the things that we've seen over the last couple of years with our rates is we've seen the treasury the spread between the 10-year treasury and our rates kind of blow out to about 300 basis points, when historically it's been around 175 to 200 bips, something like that. Do you think that's going to continue to tighten up as rates come down? Because my layman's understanding of the whole thing is that the reason those spreads have been blown out, it's sort of good news, bad news. The bad news is rates are higher. The good news is the reason is because the markets think that rates are coming down and they're worried about prepay speed. So they're not going to pay up for all these loans that aren't going to stay on the books longer term, right? So what are your thoughts on that? Are we going to see those spreads tighten up?
Yeah, it just they're just too high. And what you said is one absolutely logical reason. Um, there's also a little bit of risk that plays into that, because if I can invest in a treasury that is backed by the full faith of Uncle Sam, that really is the only true guaranteed investment. Um, you still take risks if you buy a longer term bond, you're taking because the value goes up and down. But I have to believe that a mortgage-backed security is not that much more risk than a treasury bond, and then the spreads come down. And I think that's going to happen really soon. Again, I think people worried that rates were going to go up too high and you could start seeing delinquencies, things like that. But so far, I see no reason that that won't come down to 175 is where it should be. And that's what I told Dave last time. I said, this forecast seems maybe like it's out there of 5%. This was last year. Just take the spread down from 300 to 125 and you're probably in your high fives. So that could get us in the fours faster.
Cool. All right, guys, we'll stay on this call because it will all be okay. Like, this is someone who lives the markets and has their entire adult life, lives the market. He's given his update. We're going to spend the next half call. What do you do as a producer? What do you do as a manager? Todd, anything you want to say to wrap this up, or any questions you have for Dan?
Well, what I want to highlight is certainly Dan's doing his updates in the Rate Watch app, but there's other things that Dan does through University of Options that he's updating us on. So Dan, what would be something that you want to talk about that you guys are providing that maybe some loan officers here or watching the video could sign up for that would be a benefit to them?
So, short of talking about products that we offer, we do our weekly newsletter, which we used to charge for. Just you can sign up for that and get it for free. And every Sunday night, very rarely do I miss a night. I do a weekly update. The first half of the update has to do with the economy. The second half has to do with the stock market. And then I give some stock picks. So if you want to get on that, I'll get the link over to these guys so they can sign up.
Yeah, I think
Awesome.
that's super valuable. I watch it all the time. It's really my favorite way to start the week. Occasionally I'll dip into it on Sunday night because I'm just so excited about what Dan has to say. And then I would encourage y'all just check out, is it universityofoptions.com, Dan? Is that where they can see all the other stuff on trading if someone wants to learn how to actually make money in the markets? Because that's what you've certainly taught me to do.
Yeah. So real quick, I'll just pitch this because I'm talking real quick because where am I sharing? This one? Yes. Because I want you and Dave to know about this too. So this is something I've worked on for forever. And what it is, it's the ability for me to take a trade in the morning and have that trade replicate in your account. So it's like a human bot. And my goal every day is usually I do it in just a couple of trades, make $200. But our members, that's one contract, one futures contract, which by the way, one futures contract requires a total of $250 in capital. It just doesn't take a lot of money. So essentially I did this on $200 of capital. But we have members then that will trade 5, 10, 20 contracts. So if I'm taking my little single $200 trade, replicating it across hundreds of members, and many of them are trading, 5 to 10 contracts. So honestly, a lot of wealth's going to get built here. I'm still, to be totally transparent, I get the jitters every day. It's really scary to know I'm about to make a trade and put it in 300 accounts. But I'm slowly working through it. This is this week, the 11th. That was my daily goal was 200. The 9th daily goal was hit 200. The 10th daily goal was hit 200. The 12th daily goal was hit. The 13th, a little shy of the daily goal. And the 5th, which I didn't show you, was actually $600. So far, just about every day I hit that goal, and members can trade 1 or 10 contracts. We are packaging this up. We call this flight path, but it's really internally, it's a replicator. It replicates what I do in your account. Never been able to do that before, because we know that our system works extremely well, both back test, forward test, all that stuff. But people's mindset really F them up. Like doesn't matter what I say or what I do, people get fear and all that stuff in, and they just don't make the right decisions. That's why now you don't have to make a decision. I'm doing it for you. But we still want / require people to learn about the futures market and learn the basics of trading. So it's kind of like a futures trading course, and then it comes with the replicator.
Love that. Well, guys,
I'm fired up about it.
yeah, no, my 20-year-old son, well, he's 22 now, but I think at age 20, he went through Dan's, trading class and has really made a lot of money. And it's made him a more financially literate, better at everything. He's starting a career in real estate now, but he'll be a smarter person because of what he's been through. And then he's a better investor. And I'm very interested on a personal note, Dan. And thank you for that, brother.
Dan
Yeah.
said
Anything else?
Guys, and we'll be a link
last
we'll
week,
be
and
a
in
link.
full disclosure, I have not signed up yet, but it will be signed up for, Dan. I'll work on it over the weekend.
Okay, but again, I'm going to swap your bot into this.
We're good. We're good. We're
Yeah,
good. Just know I'm fired up. I'm fired up.
Okay. I just don't want any more of your money.
All right.
I'll take
thank
everybody
you, my
else's.
friend.
All right.
Todd, anything you want to say before we bring in Mr. Kiefer?
Yeah, I mean, let me give my, you asked me to do my win by
And you
noon.
can stop sharing the screen, Dan, whenever you get a chance.
Okay, sorry.
Let me just highlight a couple things that Dan said. You said, hey, do your win by noon kind of wrap up. I mean, one thing Dan said is if I was a loan officer, I would actually be using these slides, right? So think about, first off with these slides, what are the, 1, 2 to 5 different slides that you want to pull out that you've got ready to go. One of the things that Dave has highlighted in this community over the last year or so is this idea of having a slide deck ready to go. So when you're talking to a client or real estate agent and you want to get a point across, you can pull up a slide. You can show them, whatever the economic things are that are important. And, you just have some really cool slides that Dan has provided you. Like think about that dot plot graph. I mean, that's a really great one to show someone to help them see that crystal ball that we're all trying to figure out. And so there's just opportunities there. So I'd be number one thinking about that. And then number 2 is be thinking in your head, right? If we're at 4% in 6 months, right? What are the loans you can do now for clients who need that relief, right? You've got clients that are at 7 in the 7s, high 6s, and maybe you can give them a little bit of relief with a lower or no cost refinance now, with the strategy and the education that you're going to refinance them again in 8 to 12 months, right? You're not going to say 3 to 6 months because you don't want an early payoff. And it's just this whole idea of having a strategy in place with all your clients. It's something you all know I've been talking about since last year when we thought that rates would be lower sooner, is that if we're having these conversations and we understand what our clients want and need, the bottom line is how do you effectively do this to get refinances now without delaying refinances by promising a 4% rate in the future? Because the thing we know is that we're uncertain about where rates are going to go. We think they're going to go there, but what if they don't? And so Daniel saw and Jeremy talked about it last week on their call. Don't rob your clients of cost savings now based on future projections. And so I think that basically as we go with Ryan here, we can unpack that more. But I think there's an opportunity. But the bottom line is this: y'all just need to work a little harder and a little more intentional. I've just talked to so many loan officers over the last 90 days who still feel stuck. And I'm hoping now that there's a 50 basis point rate reduction and it's got our consumers thinking about what we've been talking about for a long time, right? Dan already said it, rates went up a little bit. It didn't move them lower, but in the consumer's mind, something happened. And certainly on all of our Facebook pages, something happened because y'all talked about it. And so now it's time to take action, right? Action is the word. That's the word of the day. And so I think that as we unpack this with Ryan, we can come up with a game plan by the end of this call.
All right. Well, Dan, you're welcome to stay. And also, I know, get back into the markets if you want and jump. But I'm always grateful for you, brother. And let's catch up offline at your next opening. We can we can sort that out via email. But thank you so much, and appreciate just all the updates you consistently provide in the Rate Watch app. And you're the man, bro.
Thank you. I appreciate you. As you know, you've been life-changing for me, and I've just loved working with you guys for a long time.
Let's keep it going, man. The
All
best
right.
is yet to come.
I'm out of here. See you
Take care,
guys.
brother. Take
Thank
care.
you, Dan.
All right,
Don't
guys.
don't stumble, Ryan. You got this.
Yeah, we know he's
Take no
got this.
pressure.
Yeah. So Ryan, let's do this. So for anyone listening, Ryan is I've interviewed him multiple times. He's a very successful mortgage advisor in his own right. He's a grand master mortgage coach. Ryan, just give people a little feel for the type of volume you personally do, and then also the region or the branch you lead. So they just kind of have this is what you do as a producer, this is what you do as a leader. If you could just share that real quick.
Yeah, first of all, proud mortgage coach user since, I don't know, sometime in the early 2000s. I think I saw you post a pic the other day of a CD-ROM. I remember getting one of those, having to install Mortgage Coach on the laptop and print
You don't
out
look
the
that old.
TCA.
You don't look that
Yeah,
old. I can't believe that you
right,
were
right.
operating back in
So
those days.
I'll take that. But yeah, so personal production, I don't do quite as much as I used to. I tease my team that I'm a part-time loan officer at best, but I'll finish somewhere around, call it 110, 120 units this year, 35, maybe 40 million. We'll see what
Oh,
some
wait,
of these
time out,
refis do
guys. Did
for
you
us.
hear that? Part-time loan officer closing over 100 loans a year. Like that, you're in the 1% at,
Yeah.
at that production level. So that's pretty good.
I will say what I'm proud of actually is I looked up some numbers last night, knowing I was coming on this call today, just to kind of see what our team was doing. And our team's a little smaller these days versus a couple years ago. There are 13 of us now, loan officers, producing in our branch, mostly in Cincinnati. We've got a small satellite up in Chicago. But I took a look through August. We funded 561 loans for about 157 million. So it's about 70 loans a month. Divided by 13 LOs, we're at 5.4 units per LO. So not quite Daniel Saw numbers, but we're not too far off either.
Yeah, no, dude, that is elite. So he is a top 1% mortgage advisor. He is a top 1% leader at that number. By the way, if anybody else that's a producing leader that, I would love to start tracking what is your personal production, and then also what is the average loans per loan officer within your group. I want to start, kind of benchmarking that a little more aggressively. So, okay, so you heard that update. You know what time it is in the market. What are you doing? Like, how are you approaching both the opportunity and the challenges? Let's do that for like 10-ish minutes.
Yeah.
And then, okay, how are you leading and helping your loan officers get to 6 loans or 8 loans per month per loan officer?
Yeah, no, great question. So in addition to, our branch, I also coach a small group, about 23 loan officers within FCM, First Community Mortgage here nationally. I've had the pleasure of coaching them for the last 3 or 4 months or so. Been helping, grow production there. They're putting in a lot of hard work, but it's been really great to see. And so there are a couple opportunities, really that the market is giving us right now with lower rates. Finally, right? The last couple of years we've been kind of hoping and waiting for this moment. But number one, I guess if you want to tackle maybe the refinance side first, sort of the maybe the elephant in the room and what that opportunity looks like. I think that if you're like a lot of loan officers, those listening or watching out there, I think sometimes there's a propensity to maybe prejudge our database, or as Phil Jones likes to say, we're diagnosing or giving a prescription before diagnosis, which is malpractice, right? We need to go in and we need to diagnose. We need to actually reach out to our past clients, whether it's someone that closed just a year or two ago or someone that closed 3 or 4 years ago and has a nice low rate, which we'll go more into in a minute here. But for the obvious low hanging fruit, I know I was maybe guilty of this at first, looking at someone who's got a 6.875 or a 7 1/8 rate and just thinking like, well, that doesn't make much sense for them right now. But you really just need to call and find out, because maybe there are other needs there. Dave, you've talked about this a lot. Maybe there's debt that they've taken on. We have record credit card debt, record car loans right now. So maybe there are opportunities for cash out refinances. The big thing we've been doing right now is offering folks, a new 30-year fix, so lowering the rate, lowering the payment, or we can get them a 20-year fix, usually a half point less in rate than a 30-year. And most of the time it works out to be about the same payment that they have now. And so it's the same payment refi, if you will, but you're knocking 8 or 9 years off of their term. And of course, that's life-changing for most folks. You're talking tens or hundreds of thousands of dollars. So that would be sort of the first bit of advice I would have. Don't prejudge your database. Actually pick up the phone, make those calls. The other thing, yeah,
Wait,
go ahead.
pause real quick, because there was two things that you did. Don't prejudge your database. And notice that he's also not just calling people up and saying, this is how much I could save you per month, and I can lower your rate by a half. Notice that I can lower your rate by X, I can, lower your payment by Y, or I can reduce your term by 8 years and it would save you X. And so we've heard that a lot. Like that came up last Tuesday when Daniel saw and Jeremy Forcier, or was that this Tuesday? Yeah, this Tuesday, those two talking, and Jeremy was calling people up. Hey, do you want to save $270 a month or $120,000 over the life of the loan? And people were like, what? So make sure that you're not just selling payment reductions. And you're
Yep,
using Mortgage
absolutely.
Coach to do that.
Oh yeah, 100% Mortgage Coach every time. So that's the play on the refis. The other thing I would tell you in our coaching, both locally and nationally here, we've realized is there's also a propensity to sort of prejudge. Well, really, should we refinance now? Maybe we should wait. We know rates are coming down. It's like, wait a second, time out. We don't have a crystal ball. We think and we hope rates are going to continue to go down lower from here, but there are no guarantees. I think Jeremy said it on the call. Don't, and Todd just mentioned this. Don't rob your clients of taking a profit now. Right? You can take a profit more than once. You can refinance more than once, because let's look at a couple different also aspects of that. Number one being, we all thought rates were coming down on May 10th of 2023, right? Everybody had that date circled on their calendar. There were a couple different, big economic, prognosticators out there saying we're going to get an inflation report, rates were going to come down. Again, what happened the rest of the year? Rates went up. We hit 8% last fall, right? Last October, November. So rates went the opposite way of where we thought. So don't rob that opportunity from your clients. The other thing, I don't believe that maybe Jeremy or Daniel mentioned this on their call, but if you think back to other refinance booms, let's pretend rates do come down to the fours, which of course on the surface is a very good thing. What's it likely going to take for us to get there, for interest rates to get down to the fours? Probably takes a recession. What happens in a recession? People lose jobs. So what happens if you didn't do a refinance for somebody who could have saved $400 or $500 a month because they're sitting on the fence waiting, and now they've lost a job and don't qualify anymore? You talk about robbing something from someone, in terms of savings. That is life-changing and not in a good way. So don't, again, don't prejudge. Don't rob your clients of taking that profit, refinancing now. They can always do it again later, right?
Dan Keller this Thursday when I interviewed him, he said, I think he used the term when he's talking to people, this is likely going to be a two-tier refi market. So he's literally in his pre-frame and script, this is likely going to be a two-tier. This is what it looks like now. And then, Jeremy is showing, and when rates go down, I could do it again. What are your thoughts on that scripting, and what language are you using when you're reaching out to clients?
Yeah, I absolutely agree with that, because that's the number one question we're getting. A lot of people think, incorrectly, of course, that the Fed cutting rates just lowered our rates a half a point. So that's one conversation, right? And then they also, a lot of them want to sit and wait and hang out because they think rates are going to continue to come down. And we talk through that as, hey, I think that's likely as well, but here's what the refinance looks like now. Here's where your break even is on this refinance. Typically it's a year or inside of a year, right? Because we're waiving closing costs and making these things pretty cheap, lender fees anyway. And so we're teeing people up for that and just setting expectations. And, we have some people that are willing to go ahead and jump on now. Like, yeah, I want to go ahead and take the bird in the hand versus two in the bush, refinance now and hope that I can do it again in a year or whatever that may be. And you have some people that are, a little more stubborn, and they're kind of sitting on the fence and they want to hang out and wait.
So Todd, if you could, instead of doing the win by noon close, how about, as a certified, exactly what to say, coach and advisor who actually just this week led a workshop of 12-ish loan officers through a 2-day experience. What are some exactly what to say best practices, or even scripting if you want to give it, for reaching out to your database?
I mean, well, and Ryan's been through it with his wife, so he's also he's certified, and I'm a guide. The biggest thing is curiosity, right? I mean, if you hear Phil talk about it, he talks about that curiosity is the fuel for great conversations. And as loan officers, we're all pretty freaking smart. Like, you all who are watching this are badasses. And so therefore, you already know what your client needs to do. Maybe there's like 2 or 3 things they could do, and the one that's probably best. Or maybe every once in a while there's 2 things that might work, but it. And so the problem is we often show up with this certainty, right? Ryan mentioned it, right? Prescription before diagnosis is malpractice. And you just need to show up with curiosity to ask more questions to try to figure out the question behind the question. What's the context? What do they really need? What are they really fearing? And so it's that whole idea. We talk about it a lot. We show up and throw up, but I tend to find, myself included, that I just go into that conversation and I'm just driving for the, hey, give me your application, give me the thumbs up so we can go. And so I'm going to just encourage you to slow down, ask more questions. And every time you think that you have the right answer, ask 3 more questions, right? That's the practice. And it's really hard to do. It's hard sometimes to get by asking just 1 more question. But when you think you know the answer, keep going and dig a little bit deeper. And I think, if you want to use kind of a phrase from the book, right, it would be maybe, could it be possible, right? You want to never insult your clients, but to me, the strategy for a lot of clients right now is do the cash out refinance now, take the hit, right? The loan level pricing adjustment for being cash out. And then when we hopefully get 4% rates next year, then refinance them in a rate and term refinance then, so they can get a better rate at that time. And so how do you then, use the question that I learned from Josh Meadow was, hey, how's your debt outside your mortgage? And instead maybe rephrase that, hey, could it be possible that you have some other high interest debts? And then pause, right? Could it be possible you have any other high interest debts? And then pause and wait and see what they say, because ultimately we're looking for this opportunity to lower their stress level and lower their defenses and get them to maybe say, gosh, you know what? Actually, I do have that. Because when you ask that, could it be possible? Their subconscious brain says, hey, actually, maybe it is possible, versus how's your debt? And they're like, no other debt. And then, you ask them 10 more questions and they're like, well, I bought 2 new cars this year, right? That happened to me on an annual mortgage review I did this year. I've got no debt, Todd. Oh, but we did, haha, it was really funny. In May, both of our cars broke at the same time. We got 2 new loans. And I'm like, wait, you said no debt like a minute ago. And now you're telling me you have 2 new car loans. Like, clients don't always connect the dots like we do. And so that would be the number one thing: curiosity. Be a little more curious, ask more questions.
And I hope everybody caught that little ninja move of, if it is someone that either has some debt consol or has some home improvement, you want to do the debt consol on the first loan. So if this is a 2-tier refi market, tier 1 should be optimized debt, cash out. Tier 2, pure rate and term refi, so that you get optimized pricing for the long-term mortgage. And by the way, if you are using a fee worksheet and you're only showing rate, payment, and cash to close, you can't vision cast any of this, which again was a big takeaway. There's a little 1-minute clip in our YouTube channel called the Jeremy Forcier Vision Cash Refi, or maybe it's Vision Cash Refi by Jeremy. But we'll put a link to that. Like, if you're watching this, we'll put a link to that. Super important. Okay, Ryan, I think we've got what you're doing. What are some of you, well, by the way, anything else you want to add?
Yeah, so
From a
it's
strategic
funny.
perspective.
Todd brought up being curious. So I've got a TCA here where I did a deeper dive with the client. This is real world, and I can share it real
So
quick.
he's got a mortgage coach presentation, also
Yeah.
known as Total Cost Analysis, TCA, for any of you new to the community.
Sorry, yeah, buzzworded them or acronym, gave him an
That's
acronym
okay.
there. So
That's okay.
can you see this?
The refi deep dive. Let's go.
Yes.
And we'll
So
put a
this is,
link
I
to
know this is
this.
right up
There'll
your
be a
alley,
link to
Dave.
this
So
down below.
Yep. So this is a client that we did a purchase for him last year, did an $850,000 purchase with 20% down. They're at 7 1/8, you see here. So we talked about what we just mentioned before, 30-year fixed. Let's lower rate, lower payment. We could save them $474 a month with a new 30-year fixed, or 20-year fixed, close to the same payment, cost them an extra $115 a month, but obviously magnifies savings over the next 5, 10, 20 years. You see they could save $33,000 just over the next 5 years alone doing a 20-year fixed. But here's where the deep dive comes in. Started talking to this client, started looking at assets, younger guy, 41 years old, probably got 20 years left, of working. Noticed, retirement balances, maybe not quite where they should be. So I just asked him, said, hey, you got a 401k here. But yeah. How much are you contributing to that? He's like, oh yeah, 2%. Okay. Do you know what your employer match is? He's like, oh yeah, it's dollar for dollar up to 5%. Kind of sat there like seeing if this would sink in with him and didn't. So we just walked through and just, to get a little more advanced here, we talked about, 401ks and how you're working with 70-cent dollars to begin with, right? Every dollar you put in, because it's pre-tax, probably going to affect your bring home pay by about 70 cents on a dollar. So what I just said was, Matthew, let's say that we do this 30-year fixed and save you almost $500 a month. And let's ignore the 20-year fixed for now. Okay. So we're going to save you almost $500 a month. You can raise your 401k contribution by $500 a month. It's only going to affect your bring home pay by about $350. So you're still saving money net, right? Because we just saved you almost $500 a month on a refi. Your bring home pay only affected by $350. That $500 a month you're putting into the 401k becomes $1,000 a month because of the dollar for dollar match that you're leaving on the table from your employer. And so then we show that over time here. I just usually use a 6 or 7% rate. We show the net worth down here. 20 years from now with a 401k. I mean, guys, this is life-changing stuff. And so this falls under the adage of the best rate on the wrong strategy could end up costing you tens of thousands or hundreds of thousands of dollars over the life of the loan. This is getting in, being curious, as Todd said, a deeper dive, becoming the trusted advisor. This is going to ingratiate you with clients longer term, repeat referral business, of course, and also with financial planners, which I know is what Dave, worked with historically more.
Guys, financial advisors will love this, and everybody should have partnerships, strategic relationships with financial advisors. Not only is it more business, but it also makes you more valuable to realtors. And then what's most important, it makes you more valuable to the consumers that you serve. Like that's just a great example of helping people achieve the real American dream of sustainable homeownership with financial freedom faster. So, bro, that's incredible. What are your thoughts in this last few minutes? Like, hey, let's do refis as fast and as efficient as we can. And MortgageCoach is absolutely never been more important to do that. For anyone that is working for a company that has MortgageCoach and has Encompass, like that Encompass integration has never been slicker, never been easier to use MortgageCoach. So just keep an eye out for that. If you work for a company and your company doesn't have a partnership with us, reach out to me, Dave at MortgageCoach, or private message me from any platform. It will help you with that. But what about the idea of a lot of loan officers are just going to focus on refis and they're going to stop leaning into their real estate relationships? How are you personally balancing that? And then as a branch manager of 12 loan officers, what are you saying to your loan officers about this dual opportunity of refis and no one's paying attention to the agents?
Yeah.
Yeah. What are you
That's
doing?
the golden question. I think it was Dan that said it best because he said, think about refinances as overtime. It's just sort of gravy. It's a short lived, it's going to be a little sugary spike. And, in this refi, it's not going to be a boom. It's going to be more of a blip. It's not going to be like 2020 or 2021. So kind of get it while you can, but do not ignore your agents, please. And we've historically done a good job of that. Back in 2021, we were still 65% purchase, 35% refi, which was kind of flip-flop from what I think the market was overall. So we're very much still focusing on our agent partners. And there's a couple of keys right now with the lower rates of things you can be doing to help your agents. First of all, we look at ourselves as not just trusted advisors here locally. We look at ourselves as conversion partners, right? So we're trying to help our agent partners save time and make money. Those are our two big things. If we can do those two things, we're going to win. We're going to get more referral business, right? So right now with lower rates, a big opportunity, especially with the NAR settlement, is to talk to people who aren't committed, almost like a lost leads conversation. So buyers who aren't fully committed to the agent, we can have a conversation with them, sort of help present or, their value prop as the agent, help them with that. The other thing we can be doing is going back and looking over the last 6 months or a year at clients that they were working with that didn't buy. If you think back to this time last year, because rates were at 8%, you have a lot of first-time buyers who probably just signed another lease for a year and didn't buy. They just kept renting. How about going back and talking to them now? Because remember the rules of thumb out there, every 1% drop in rate brings 5 million more buyers in the market, right? So we've had rates come down about 2% from 8% to 6%. You got 10 million more buyers out there right now. And also the other big rule of thumb is every 1% in rate equals 10% in purchasing power. So if someone couldn't afford to buy last year at 8%, a rate of 6%, gives them 20% more purchasing power. Now they can likely buy. Maybe they can qualify. Maybe they couldn't before. Maybe it moves them up a price bracket to where now they can get a home that checks all the boxes. It's the home of their dreams. So the more we can be out there educating agents, I know I'm out there a lot educating them with those rules of thumb, and they love those kind of things, little things that they can use with their clients and kind of educating them accordingly.
Love this, man. That was great feedback. So before we run out of time, I know you also recently joined the Modern Mortgage IQ community, and you also went through that assessment. By the way, guys, I'm going to put a link to the free assessment of, Modern Mortgage IQ. But why did you get involved in that platform?
Yeah, I mean, that was a no-brainer the day you guys offered that. I think there was a little bit of a discount to sign up. For me, I love this community and what you've put together over the years. I don't always catch the calls live, as you know. I usually catch them the next day or the day after when I'm on the treadmill or, in the car driving back and forth to the gym, in the mornings, what you call net time, no extra time, right? Instead of listening to music, I'm trying to better myself and the team by picking up some ideas from other top producers out there. Why reinvent the wheel, right? You've got people out here in this great community that are flat out getting it done. If you can just take little things here and there from all these great folks and make them your own and make them work in your market, I mean, it's a no-brainer.
Yeah, so guys, check it out. All of the content from the past 5 years of the Modern Mortgage Summit and the Modern Real Estate Summit are all in that platform. You can go to modernmortgageiq.com, check it out. I also put a link to the actual assessment. It takes about 2 to 3 minutes to assess where you're at as a modern mortgage advisor. So Todd, any questions for Ryan? Is there anything you want to kind of wrap up from a win by noon action plan?
Yeah, I loved everything, Ryan, that you had to say. I real quick want to address Melissa's question from the chat. And it's, hey, what do I say if I haven't actually talked to a client in 3 to 5 years, right? Call reluctance is real. And especially when you haven't talked to someone in 3 to 5 years. And especially if you said, hey, I'm going to proactively manage your mortgage and check in with you every year. And oftentimes we didn't check in with our clients over the last couple of years that have, 2.5%, 3% interest rates. And so it just unfortunately takes a little bit of a humble pie, right? Hey, Ryan, it's me, Todd Bookspan, your favorite mortgage guy. Hey, I really apologize. I haven't checked back in with you. But I'm sure you've heard that the Fed has lowered rates by 0.5%. And I just wanted to check in and see if you had any questions for me about what's going on in the economy or in the housing world. Something along those lines will help. I would tell you this, right? I did the cash out refinance thing I'm talking about, hoping that rates would have been down sooner. And guess what? They sold my loans to Rocket Mortgage. And they sent me these really nice packages that's 4 or 5 of my houses that I did that for. And I'll tell you, it was a huge wake up call to me because I realized that the company that I worked at, which wasn't a seller service or it wasn't a servicer, they were a seller servicer and they sold the loans. It's the 3rd time since 2021 that they have gotten sold, and they got sold to actually a really good mortgage company. And so for me, it heightened the sense of urgency because I realized a lot of the loans that my team did during that time, guess what? They went to Rocket as well. And, y'all don't like Rocket. You think that they're not that good, but they're great at training their loan officers. And so that's your competition now. Before it was like the automated call from, the random name servicers that I won't mention. They'd be like, hey, it's time to refinance your loan. But this is like big. This is big. You all have competition out there. I had a friend of mine call me the other day who said, hey, Todd, I got the letter you sent me about the fact that I can pull out cash and refinance my home. Guess what? That wasn't from me. That was from some dirtbag loan officer who was quoting a rate that was almost 0.75% lower than the actual market for a cash out refinance for this client. And I was like, ooh, okay, we're all behind. So it's okay. It's action time, right? You got some great ideas here from Ryan. And I love what Dan Keller said. I wrote that down, right? The whole idea that refis need to be overtime. And I think that this is it, right? If I was in your shoes and I haven't talked to my database, and even if I have, I would be making sure that I have an action plan. And I would probably spend this afternoon, and I might even spend part of my Saturday. You all know I hate working on the weekends. Figuring out who do I need to reach out to and start reaching out to them, and then just make sure you've got a really, really strong action plan going into next week. Review your database, set up those calls, and block some time to do it, even if it's in overtime. So Dan, it's 10 o'clock.
Hey, real quick, Todd, any objections? Like, I personally think if you're calling people with some real value, like 3 to 5 years ago, why even apologize? Why not just call, hey, this is Dave with X company. I helped you with your home on, blank address. And go right into, I'm checking in with you because interest rates have come down. People, that I helped at that time, and then do like the whole Phil Jones. They've either outgrown their home, they want to pay off their mortgage faster, or they want to reduce their monthly payment. And, which are you? Why even do the apology? Do you really think that's necessary?
I think it's a comfort tool for a lot of people, right? I don't have to do it anymore because me and my team have kept in touch with all of our clients. But that's for me when I felt bad that I hadn't done what I said I was going to do, because I always said I'm going to proactively manage your loan. So I like that because it made me feel better going into the call. But I think you're right, Dave. You don't necessarily have to, right? You absolutely can go in with confidence of, hey, I am the person. I'm the gal or the guy who did help you with your loan. I'm not the imposter that's reaching out to you. I'm not the servicer. I'm not the random loan officer who, is getting back in the business this week because, they can actually do some loans. And so, yeah, you're right. You can absolutely go into it with confidence. And then the biggest thing is don't make that initial thing that you say to them so long that they feel overwhelmed, right? Your whole goal is how quick can you get it into curiosity, right? How quick can you get it into asking them a question that's going to really work for them? And the bottom line is, though, just make the calls. You can screw it up all day, right? By the time you made your fifth or sixth one, it'll be pretty good. One of the things that you could do is if you go to my Instagram, Deborah and her plug and play folks created on that little round thing. I don't even know what you call it. Below my profile, they have these different things. I did a series of calls on how to have better quality conversations, and I go through what to say, how to do it, and then kind of how to get more of them. And so it's like there's 7 whatever 1.5 2-minute videos on my Instagram. If you just go look, you'll be able to see that might be a good opportunity for all to get a few other bits of advice since we're tight on time.
Yeah. And by the way, Todd is valuable on Instagram. If you do not follow Todd on Instagram. He, does a walk with Todd every day, and he delivers value. Like, he's giving you little pushes, little reminders, and then, that extra little advice that he gave you, it's pure gold. Ryan Kiefer, any closing thoughts as we are a little
Yeah.
over, but I want to give you the
Yeah,
final word.
yeah, real quick. That was gold from Todd, as always. I will mention kind of in addition to what he said to piggyback on that and to answer Melissa further. So if you're thinking about clients that were 3 to 5 years ago, maybe don't apologize. Like, hey, your rate's at 3%. You've been in good shape. However, we're calling people because we've seen the people, the Phil Jones. They've outgrown their home, they want to pay other debt off, they want to release equity, et cetera, et cetera. So keep in mind that there was a recent survey for millennials, first-time buyers from 2020 and 2021. So the people who have these 3% rates. These millennial buyers, 72% of them are unhappy with some aspect of their home right now. And the biggest reason, 27% of them do not like their location. So think about what was going on back then. People bought in a hurry. It was really competitive. It was COVID. They didn't have to drive to work. Now they have this commute that might not be great. So anyway, just like the refis, don't prejudge your old database just because they have a 3% rate. They might be ready to move up or move into a different house. So make those phone calls.
Beautiful, guys. Well, hey, we are a few minutes over. I hope you got value. Every Friday, 9 o'clock, we are masterminding with you. There's lots of value in our Facebook mastermind group. If you have questions, put them in there. Remember, Dan's slides will be in there shortly. Every Tuesday, I'm interviewing someone amazing. Who am I interviewing this Tuesday? Want to remind you, Ryan, is it you again? Are you and I
No,
doing?
you had me originally, but we moved it up to today. So
Okay, well, I'm not sure exactly who I'm interviewing on Tuesday, but I'm going to interview someone amazing. If you go to savageinsights.com, I update that every single day. So whatever is the next interview I'm doing is at the top of that. Right now, if you want to learn more about our services or products, a few links down. Whatever I think is the most important, like new short video, we're creating more clips than ever. So if you are not subscribing to our YouTube channel and getting alerts, there's just a lot of 1 minute, 2 minute videos that will help you be more valuable. And then again, make sure you go through the First Home IQ assessment. I've shared a link in chat. I put a link down below. If you have not been through that assessment, it's pure gold. It's pure value. Todd, are you good to go? Any last thoughts before we wrap it?
We are over time. Bottom line is this: you just got to take some action. Don't hesitate. Imperfect action is way better than perfect action that you never take.
Boom. This is a wrap. Have a killer weekend. Take care.